Hey guys, Mike here. So obviously big week in the market this week when it comes to economic data, and also we are starting earnings season, and there are some very important earnings coming out this week that you need to be aware of, especially if you own these stocks. But it is going to give us a huge insight to the health of the financial system, right? And the health of us, the consumer, as well. We're going to get a lot of data on that, and we're going to go into that, as well as some things that are happening that are absolutely going to affect the market for the positive or the negative, right? And I mean, if you look this week, we'll get into that right now. And there's one other thing I'll tell you before I even start that I'm going to be watching like a hawk this week. Everybody's going to be watching it. The algorithms will definitely be sitting there waiting to be triggered if this event actually happens this week, okay? And so if you look at the economic data, it's going to be huge. I mean, Wednesday, PCI, Producer Price Index, PPI, I should say, excuse me. FOMC minutes, going to be Wednesday. And then the big ones, Thursday, October 3rd, put it on your calendar, CPI data, right? Initial jobless claims, continuous jobless claims. And then Friday, we get retail sales. Are we still buying and running up the credit cards? And then earnings, right? Nothing, but here comes Thursday. We're going to get BlackRock, the first financial institution, and then Friday is just financial institution mania. We're going to get a ton of data to see how we're doing, how much money is going in, how much investing they do, how IPOs are going. Are there any IPOs? What's going on overseas as far as, because remember, some of these guys like BlackRock especially is global, maybe insights on China, Europe, all kinds of stuff when it comes to financial markets and the health of it, right? They'll probably start talking about liquidity a lot in those calls, and so that's going to be big to watch. A lot of people, I think, from what I understand, they're really looking at the financials to start to melt down, right, as this liquidity starts to shrink. And so especially when it comes to real estate and the mortgage industry and everything else. So that's a big one. So make sure I'll keep you guys informed on that one. But one thing we're going to be looking at is, obviously, the S&P is below the June lows again, where it closed on Friday. Here's the new low right there we are heading towards. You can see if we break that, obviously I think we know that is going to be huge and not very good for the market. This gap right here, which I thought we'd fill, we actually just skipped right over it. So the gap is still there because it gapped down below it. Try to draw this out. So if we head up, look for a gap fill, but right now I don't think anybody's expecting that come Monday. But the big one's going to be the weekly 200 moving average, right? We were sitting on it again. Here we are, right on it. And so people are going to look to see, do we close below this moving average? Because if we do, on the S&P, again, we broke it in 2020, but you got to go all the way back to 2011, right? So 11 years ago to where we officially broke it right there. And it was kind of, barely broken and came back above it. And then you look at the QQQ, this is even a bigger support line because we have not broke this, and you can see there we are, just basically sitting right above it right there. And so if we close below that moving average, you can scroll back, didn't break it in 2020, hadn't broke it, and you go all the way back to, what is this, 08 right there when it came down and broke it. So that is an enormous support level psychologically, and the algorithms are going to be all over that one for sure. And so two important pieces we need to look for this week, especially when it comes up to Friday, even you can listen to BlackRock on Thursday, is how the consumer is doing. So far, we're holding up, but how are we holding up? What are we doing? I showed you last week, at 2.2 trillion, it ain't there no more. It's dwindling down. It's dwindling down pretty dang fast because of all the expenses. And what is happening now, I don't know if you've noticed, things are starting to go back up again. May not be happening in your area. It's happening in my area. We can see it. It's plain as day, and I'm going to show that to you. But you can see these are the two things we got to start looking out for. Is what it's all about. Revolving consumer credit, personal savings. There's personal savings right there on the bottom. And then you see consumer credit right there at the top. And obviously they're going two different directions, right? So we're basically spending up all our savings, as you can see. And we're spending up the credit cards, revolving credit lines, all kinds of stuff like it's going out of style. It's at an all-time new high. And if we just draw a line right here, you can see right there, we're going all the way back to basically 2007 levels now is where we're at. And I don't even have to draw a line on consumer credit because, again, it's at an all-time high. And so we are definitely running up the credit cards like crazy. And the reason why we're still spending, right here, job growth. It still remains solid, right? 3.5% unemployment, historical low right there. It just keeps going down and staying in that 3.5 to 3.7 range right now, which of course the Fed doesn't want. They don't like it. And then you can see right here, job growth, right? We still have more job growth. We hadn't had a negative number since, what was that, 2020, I think in December, it looks like right there, or maybe in January 2021. But we're still producing jobs. A lot of those are part-time jobs. There's no doubt about that. Because a lot of the companies are doing what? They're cutting costs. How do you do that? You cut benefits and you cut hours. If you get below a certain amount of hours, don't have to give you no benefits. That saves the company money, right? Got the holiday seasons come up. Going to have a whole lot of part-time jobs coming up. A lot of people are working 2 jobs, no doubt about it. Some of them 3 jobs. Just try to make ends meet out there. There's no doubt that is happening. But the one thing you'll learn, and it's disturbing as it can be, and it's actually the reason why I started this channel in the first place, but is it's amazing how the percentage of the population that is literally just like financially illiterate. They don't know how to do a budget, don't know how to balance their checkbook, even if they should keep a checkbook now, but their account at least. They just feel if they have it, they just spend it, right? I mean, people like this. I'm related to people like this. I know people like this, and there's a lot of people. All right, there's a reason why there's a big percentage of the population that lives paycheck to paycheck. I remember my mom, even if she got any savings, she spent it on something. I mean, it was the norm to live paycheck to paycheck. I would be so stressed out that I swore when I was a kid, I will not live like that because the stress would be too much. And so, I do whatever. I remember even when I was broke, doing whatever. I always, even in the military, you're poor as can be when you're a private to Lance Corporal in the military. But I always had money put back for savings just in case, right? Too much of the population don't believe in that. Most of them have spent all that stimulus money, all right? That is gone for them. And as long as inflation stays here, God forbid it rises, those will get worse. And that's where this comes in at. This is what everybody's looking for too right here. The forward PE ratios, right? We're at 10, I'm sorry, that's October 7th right there. We're around between 15, 16 now. And if we draw this line across, you can see basically everybody's projecting between 12 to 14. Nobody knows the exact number because it's not about where you go to, it's about where you started from, right? And you can see where we started from in '08. Look at that. We started where we're at right now in '08 and went down, but look where we started in the dot-com bubble. Look at that. And then we ended basically where we're at now. So it's really the drop is what you're looking for, not the exact numbers. Like the people think we're really going down to 7 or something. But people are looking between 12 and 14. That's what they're looking at right now. And what will cause that? Earnings now. That's what's going to cause it. Because, we're going to find out again. Listen to the earnings reports. Are we still spending? Are we still buying the products? More importantly, are we doing the services? Because 70% of our economy is services now, right? And so are we still going out there? I mean, I see restaurants still full, people still traveling right now, doing their thing. You just don't really see it. And I'm sure certain parts of the neck of the woods out there around the country are having problems, no doubt. But we're still doing it, still shopping on Amazon, all this other stuff. And, the other big thing is going to be the inventory problem. You see Walmart, Target, all these other companies are having, that's going to affect earnings. And, of course, everybody's expecting that compression now with earnings, and so it should bring it down. We will see. The problem is we keep getting these rallies, right? So then it spikes it back up, then we try to work our way back down. That's something to look at. But I'll tell you one thing right now to keep a close eye on too, gas prices, man. I mean, you just see them right here. What do you see going on? Here was the average a week ago. Here's the average now. So we went from 380 roughly. Now we're at 391, and it was quick, right? I mean, that's a big jump in a week, and we had dropped all the way down from quite a bit. But as my father-in-law told me, who works in the farm industry, forget regular gas, you need to look at diesel. And if you look at diesel, you can see right here, 487, and now current average is over 5. So we're back over 5 from them, which is not good. And of course, this is so important because what's going to happen if it continues to rise? Transportation costs, which have been dropping, will go back up. That will in turn affect everything. Food prices, anything that needs transporting will be affected. And so the food's the biggest one because it was still increasing, right? And so you don't want that to go back up. And this is what I talked about a couple months ago, which people had brought up too, other people, which is, yes, this is what happened in the 70s. Inflation started coming down, and then boom, went right back up, right? And so that's what I was saying a few months ago. Just be open-minded. You always got to be open-minded and data-dependent when it comes to this stuff. So everybody's talking about it's peaking and coming down. That can happen. But what we talk about, and a lot of people rejecting oil to go back up. Didn't know why. Well, of course, now OPEC doing their big cut or whatever, which supposedly they're already behind by, I don't know if somebody said in the comments, 2.8 million barrels a day. So actually, it wouldn't even be a cut or something like that. But either way, obviously, the news has affected the oil market, right? And we're still releasing petroleum reserves, which are supposed to be stopped this month. But now they're talking about doing 10 more barrels in November or something. And now I don't know what it means to be down to 84 levels in our reserves, but I think it probably couldn't be good. And I guess I don't know what price we're going to be buying that back at, which isn't going to help at all either. But, you know, just imagine once we stop releasing all those reserves, 1 million barrels a day, what's going to happen to prices then if we just stop that? I don't, you know, I'm not an expert in oil, but to me, I just look at supply and demand and go, probably not going to be good to bring it down, right? And so I think that's why a lot of people say the only thing that's going to bring down oil prices like it always does is a recession, right? That we're just not using it. That's what happens, right? That's why I was dropping before. It was so worried about the demand. Well, now I'm sitting like, well, I mean, Q3 GDP is projected to be positive. And if that comes out positive, that means we're really not in a recession, right? And employment numbers stay strong, whether it's part-time, full-time, and, you know, that kind of stuff. And we have credit cards to spend, not cash, but credit cards to keep spending, as long as those defaults, which I'm looking into now, and I'll bring it to you, you know, doesn't spike up, because I've showed you that's usually what happens. You start to see those defaults start to creep up and take off before you ever really see a real recession, you know, talked about or officially put in place by the government agency that does that. You know, like I said, you're not going to see it. There's no way you see that before the election. I couldn't imagine that's going to happen. So that's why they've been quiet as a church mouse. But, you know, and other things to watch, like I was telling the members, watch the treasury rates, you know, watch the dollar, oil going back up. We've seen what happens. What happens when oil, the dollar, and yields head north? What happens to the market, right? And with those support levels in place, critical support levels in place, you know, it could be a rough week, or the only thing that can really save it in my eyes if CPI data comes in below and the market's irrational anyway and it goes, yes, and it wants to move up or something. I mean, that's pretty much where we're at, right? And I'm going to come out with a video tomorrow going in detail of what exactly, because everybody keeps, you know, they want this capitulation moment, they want the VIX to spike, and I'm going to show you exactly what made the VIX spike. And you got this capitulation moments in 2001. You got actually multiple times in 2001 because it was such a drawn out drop in the market. And then, of course, in 08, what caused that? You know, as far as I'm concerned, I'm taking 2020, 2018, 87 out of the equation, because those were like 3 to 4 month long, you know, crashes, if you want to call them that. They were fast, right? This obviously isn't fast. This is death by 1,000 paper cuts. And the Fed obviously is sitting here, probably going to do 75 in November, 25 to 50 in December. And as long as that continues, you know, and if they stop there, then maybe we see something different. But I'm also going to show you in that video tomorrow what I'm talking about when I say you got to be open-minded to this market trading sideways and being range bound, right? It's not the bottom or anything like that, and anything like that, but you got to be open-minded to that, you know. And I'll show you how in 08 it happened, 2001 it happened, and it's for long extended periods of time. So you have to be open-minded to that stuff. So just FYI. So for those who are sitting on the edge wanting to either buy or sell or whatever, you're just wondering what to do, whatever, at least I'll give you more data to say, okay, let me take that in consideration. Again, this is a year first. This is one that will go down in the history books, no doubt, because I'm pretty sure we've never had this many, I think I've said this multiple times, like elements taking place at once, right? And so the equation is very complicated, to say the least. So anyway, I hope you guys got something out of it. I will see you tomorrow. Let me know in the comments what you think and everything, and what you're looking at this week as well, okay? So have a good one. I'll see you tomorrow.